Welcome, everyone. It's now 12 o'clock Eastern Time, and I'm glad to see you all here. As you know, we're running on Swiss time because there's an old saying, you never trust an astrologer that comes late. But we will give everybody a minute or two to come in since people may have a little difficulty coming on right away. We have a very exciting program. We'll go over some housekeeping rules in the beginning, but I want you to realize this is actually a very serious talk. I think there's a lot of information here that's not all mainstream, some of which is, but based on our history for the last 30, 40 years, I think it's fairly valuable information. This is what you have to think about. So I want you to realize our basic theme is invest for 2024, not for 2023. This is very, very important. The second point that's as important is the bear market's not over. So I'll let you just sit with that for about 10, 15 seconds. That's the two themes that we want to break home to you very strongly. Housekeeping rules. Number one, we're recording this, and we'll be posting it in a couple of days on our YouTube channel, Henry Weingarten. Not only can you review things, but it means you don't have to take notes if you want to. Later on, there's going to be a lot of information with a lot of data on it that will be posted so you can catch it there. Naturally, you're also welcome to invite your colleagues and friends to watch. As the Q&A, that's one of the advantages of being here, that you can ask questions, and as the best I can, I'll answer them at the end. But I'd like you to use the chat room just for that, to put them in there, because I know very often when I have a question, I'll be talking maybe 15 minutes, and by the end of an hour, you may forget it, and this way you don't have to write it down. You can simply put it in the chat room. So that's sort of the basic housekeeping. Okay, and then the important disclaimer. According to my lawyers, this says that if the market doesn't perform correctly, in other words, if the market's making a mistake, not me, I'm not responsible. Obviously, do your own due diligence, and hopefully, based on history, most of what we say is true. Not everything, but most is true, and hopefully you can integrate it into your own work. But if you have questions about it, obviously speak to your professional advisor or do your own due diligence. So, according to talking heads, you shouldn't even be worried. Everything's going to be wonderful, isn't it? For example, 81% recently of millennial millionaires expect their assets to be higher the next year. That is not a given, as we'll see very closely. So our view is worry, but don't panic. Anyone who tells you we're not in a recession or going into a recession is in la-la land. That's clear. Sometimes, maybe this Friday, for example, the news will be such that it doesn't look like it's a recession or inflation is dropping, but that is not true. This will be the effect on many people. Obviously, if you're ultra wealthy, it's not going to be the case. But for most people, they're not going to be spending like it's New Year's Eve and parties here. And you'll see that in the retail sales coming up, not only for December, but for January and certainly the whole spring. 3 considerations. First, of course, there's the traditional presidential election cycle theory that says that markets tend to surge in the 3rd year of presidency. That works most of the time since the presidential inaugurations changed in January, but not every time. Number 2, there are 3 there are known unknowns that will highly affect marketplaces. The first is When the Fed will pause, will it be in 2023 or at all? Secondly, the Ukraine war. And third, China's zero COVID policy. Has it ended? Is it paused? Will it be reinstated? Each of those three are some big plays that will tremendously change whatever position you have, long or short, which means some hedging is required if you're making big bets. The general view we agree with is the large case with Morgan Stanley for the first half of the year, which is that we're likely to see a 33,000 to 3,400 price increase. Those of you that followed our work last year, so we were very close to the top, got the market to 3,800. Then again later we got it to 3,600, and now of course we're predicting this. But there's a big difference about whether there'll be a sharp finish. We're going to talk about that. But the general view among the consensus is that markets are going lower first quarter because obviously earnings are not going to be robust, and many think we'll end up about where we are now, which is approximately where the markets were when Biden was inaugurated. What you will see, we have stagflation, and stagflation is recession plus inflation. But, and this is the most important but, it is a stealth inflation that you're going to be seeing. And stealth inflation is known as shrinkflation or shrinkflation. What that is last year, for example, I have 30-day vitamins I take daily. The pack now is 24, same price. Right now, I go locally where I can get a wonderful display with salads with about 35 ingredients. One ingredient, avocado, is no longer allowed with the other 30, tuna, etc. But it's $2 extra. In other places where I very often go for breakfast with large buffets, we used to have avocado toast included. Now there is none. And the third thing we're going to see, of course, is one of the things that happens in inflation is people adjust. For example, right now, Prosecco, right, is way outselling champagne at New Year's Eve. One reason it's a third the cost. So we're going to be seeing this shift to cheaper substitutes. That doesn't mean there's not inflation. We're going to be seeing more shrinkflation and items taken out. So it's not always going to show in the government reports what's happening, but we have stagflation, which is recession plus inflation. The second point that's important is that valuations are going to matter more and more in a slowing growth environment, and that means PEs are coming down. And you're going to see this, for example, when we take a look at NASDAQ, which is only down 1/3. But some of you remember, who've been in the markets longer, when the markets were 4,000 and 5,000, and they dropped to 25,000, and they dropped then below 2,000, because their PEs are 50, 100, 200. And then this is another very important point. We're going to go into this in a lot of detail, but I want to give you the basics. There isn't actually a bifurcated market. That is winners and losers, and we all see winners and losers now. Of course, a lot more losers than winners. But the market's actually split into four parts. Those that are in prosperity, for example, the military stocks. Up until the beginning of the year, your biotech stocks, not now. Those stocks that are recovering, which are good to buy, stocks that are weakening, and stocks that are in depression. So we have this, and we're going to see that means index investing is going to underperform good, solid stock investing. Okay, so, but the main point for here is we have stagflation, but it's stealth stagflation, which means the government's not going to show it as much as is the case. Last year, we talked about the stagflation crisis and to be aware of high leverage, risk, and fraud, especially in things like crypto assets, and we see FTX. There is more coming, a lot more coming. But at the same time, this is opportunity, yin and yang. Distressed investing, and the distressed investors are doing well, but you ain't seen nothing yet compared to next year. So a general approach, and we're going to get into specifics, is obviously income, dividends, and value will outperform growth, which it does periodically, because if something has 60 PE, in fact, if it has more than 35 PE and it's not growing, then that PE is almost definitely going to drop. Stock picking will outperform index funds. Many years, index funds outperform most stock picking, but not last year and certainly not next year. And as no surprise, be prepared for high volatility. One of the things I like to do is to give you 3 winning trades. Some of you may be impatient. I've already been talking 10 minutes and I haven't given you any money yet. So we're going to, in a moment, give you 3 trades that you can make money so you can log off the screen if you just don't want all the details. But let's talk about the last 3 winning trades that we offered. First, we recommended buying silver under 20 for a fall rally. What basically happened was, for those of you that follow us on our Twitter accounts or our Telegram accounts, twice from 18 to 20, we made it. And of course, one time we got to 24. So whether you made money once, twice, or 3 times as traders, we get an A for that. The next one was buy India, because for fundamental and astrological reasons, India, we expect in the 4th quarter to do very well. Unfortunately, or fortunately, depending on what you bought, you made only 0 to 10%. You didn't lose, so we could say you outperformed the market, which obviously lost money. But 10% is not a great trade. So we're going to give ourselves a B- to a C for that, depending on if I had a tough teacher or not. But the other or of that was we could say we could buy gold under 1800. And again, that was 0 to 10%. Gold hit some targets we were looking at. So that wasn't great. But if you were short, as we were, and stopped and covered on the fall equinox, depending, both stopping and covering, from 4,200, we got to 3,800 and 3,600. So that was an A+. So A, B-, C, A+. I think that's pretty good, especially for the price you paid for the information. So let me give you 3 more. So this is our 3 swing trades for those who are very, very impatient. First of all, no surprise, we're bearish on markets. And you've got 3 ways to play that. Excuse me 1 second, I have an important email here. Okay, the first is anywhere roughly from 4,000 to 4,200, depending on your view on Friday, we would short positionally. And if you look at the bottom of that, you'll notice that currently our recommendations have been to short the bonds from 345, and we had S&P shorts from 39.63 and 38.95. So that last one we may or may not hold out. So just a positional short, which we can hold for the spring, or time shorts. And the time shorts are before January 5th, roughly around March 1st, and then again roughly around April 22nd. So that's one set of trades. The next trade, if you don't want to do those 3, is to buy Mag Silver, who's actually one of our sponsors. We very much aggressively went after them as a sponsor because Mag Silver is our desert island pick for this year. Desert island means what would I buy now, come back next year at this time, and be a happy camper. We're going to go into that in some detail because we don't have that many desert island picks. Then the third one is a choice. We could buy oil, which we're constantly trading, and we were basically very long the first half of the year and then trading both sides, but more, actually both sides in the second half. At this point, the 69 to 72 we think is a good floor, and we want to look at every opportunity to go long, especially as we get to the spring and summer. That's mostly a fundamental play, and it's worked out very, very well. On the other hand, here's a very high speculative play. TMC is something you're trading for either 2024 or 2025. It's called the Metals Company. And what it is, it's basically undersea mining, which is extremely rich. But it won't go into early production probably for another year and a half to 2 years. It was a $10 stock not too long ago. We thought it was rather expensive and way ahead of itself, as is often the case with advanced technology. When it went to $3, we did a little nibble, recommended it, at $1 again, and here in the 50 to 68 cents, it's a no-brainer for us. But it's highly, highly speculative. You've got to know what speculative capital means. That means money you can afford to lose without materially changing your website, and only a small batch. But if you want one, it's one we like. We certainly have a $3 target for it over the next 2 to 3 years or earlier. It's got support around 50 cents. If it broke that, I'd watch it. But it's a very highly speculative play. So we got 3 winning trades for you: shorting the market, both time and price, buying Mount Silver, a desert island pick, and then a choice of either buying oil positionally or buying this very exciting future stock. And of course, you should look them up. Okay. That's it for those of you that just want to make money and leave. Now we're going to give you lots of details, and if you're willing to work hard, we'll make a lot more money. Inflation is coming. It's not a question of being afraid of it. It's a question of benefiting from it. You must have that attitude, or you should have that attitude. And this includes all the classic commodities: gold, agriculture, real estate, which is a mixed bag, because not only is real estate location, but with higher interest rates, there are issues. You have to worry about defaults, the same way banks do at the moment. And less so the discounters, and we did very well with the discounters because people went to the top and the bottom. Middle class is always squeezed. The discounters did very well earlier. Now it's an issue of supply. It's an issue of even people holding back. Ultra luxury is still doing extremely well. But the thing is, people benefit from inflation if they're profitable companies with pricing power. Very simple value concept. If you buy the market today, not stocks, if you buy the market today, there's limited upside. Sure, we could see 4,200. Anything above that, I'll short and come back on a desert island. The vast majority of market professionals believe that in the first quarter or first half of the year, markets will strongly correct. Some say 10%, some say 15%, some say 25%, and you've got Robini saying 50%. But the point is down, not up. There's no good news or good enough news. So we hedge, we stand aside, raise cash, short, high cash levels, little or no margin, write calls, buy puts, hedging, very short-term trading, because you can take the trade and it's gone by 9:30 if you take it overnight. Markets are extremely volatile, and we're buying investments for 2024, not for 2023. Okay? Limited market upside. Fundamentally, there are a couple of positives, if you wish to call them. The Inflation Reduction Act, not named correctly, but it's stimulus into the economy. The China zero COVID policy may be ending, maybe not. They could come back tomorrow. When there's a Ukrainian ceasefire, that will be a sharp rally, although we'll probably short it in a few days afterwards. Plenty of cash on the sidelines. The belief or hope that inflation is peaking with a Fed pause, and if it pauses, it's a horrible mistake. They've done it before. And we're in year 3 of a presidential cycle, so we have a few positives. In comparison, there are many negatives. And the most important ones, in my opinion, are inflation concerns, because inflation is not going to be below 5%. We could be that lucky. Some of them are short-term, like the inverted yield curve. But one of the things is that when the meme stocks and the crypto collapses, we're going to talk about this in some detail. If you had things like BBBY, FTX, HKD, which went from 10 to 250 to 10, the COVID issues. But the big thing is declining earnings and leading economic indicators are not very good. You still hear me, right, Mark? Yeah, sorry. Somebody seems to be on there. And of course, the usual potential black and white events. So what are we looking for? And the landmines that we're specifically looking for is inflation, going back, probably not 8%, I'd say over 6%. Bitcoin collapsing. Remember 2 years ago and last year we talked about it breaking 30 and 20. When it breaks 10, we're going to talk about it. We see FTX, but Tether's the biggest fraud out there. Never been audited. And that's underlying the whole crypto community. When that goes, and it could be this year because regulated exchanges are going to be required. You're either going to do... And then finally, the issues with Russia and China. So there are a number of landmines there. We're going to talk about them in some detail. I've talked about this many times. There seems to be some noise on the screen. One second. Let me just see what's going on. Everyone should be muted. You can still hear me, right? I don't know what's going on. Excuse me a moment, but... All right. Somebody screamed there, but I don't know why. Okay. It's different this time has been a theme for a while. It's different than 1971, it's different than 1987, it's different than 2001, and it's different than 2008. Why? Number one, there's little reality in today's markets. It's all crazy stuff. So fundamentals are important, but it takes a while. One second, I'm trying to find out where that noise is coming from. Okay, so you have to be careful of that. We still are dealing with the coronavirus, now a triple threat, which is an issue. And then we have computer dominating trading, so it's up to 90%. In volatile markets and faster trading times. So things are different. They're not what you read from 20-year-old books or even 10-year-old books. So things are different. This is last Friday's news, and you can see roughly the areas we're trading in. 3,800 to 4,000 is pretty critical. We have basically 4,000 as overhead resistance. 3,800 is fairly strong support, but we expect it to break first quarter. So you can change this. These numbers are in there. And the 50-day average, around 38.63, is approximately where the markets were when Biden was inaugurated. 2 years going no place. Bitcoin, we know, is not a favorite investment environment, which is not the same as stable coins and other things. We recommended 8. Very successful, actually 7 out of 8 very successful trades on the short side. But it's delusional to think that it's going to be ignored. You're going to either have to go to a DeFi or you're going to have to go to a regulated exchange. What's happened with FTX is going to be a problem, and that suggests that Tether is about to go next year. We haven't done the astrology on it, but it's pretty obvious it's going to go. Now, there are advantages. Obviously, if you're in Ukraine, if you're in Venezuela, it has some short-term. Zimbabwe, it has short-term advantages, but Bitcoin is not going to be the play. I'd be definitely avoiding it. You can trade it to kazoo both ways, but it's not an investment. And someone was telling me just yesterday that it's primarily a store of value, and that I could not believe people could repeat that. And this is a chart that some of you know. Under 20, which is where we are, investment pros better be very careful who they're recommending it to because of suitability suits. When we get to 14K, whales are going to fight. They haven't given up yet. We get to 10, the long-term holders are going to worry about it. And we get to 6, game's over. So these are some interesting points. Obviously, 16 and 20 are the 2 key support areas and resistance areas. But when we get down to 14, if we do next year, bye-bye. And I think Tether will be the reason. Okay, we happen to like gold. Most of you know that. We're going to go into some gold stocks we like. We think it's going to go higher. For a number of reasons. The pricing we have, and why do we like it? Just basically, it's cheap geopolitical crisis insurance. And primarily it's for investors who cannot or will not buy the U.S. dollar, as well as investors who want to safely and cheaply hedge their U.S. dollar exposure. Only gold's as good as gold. It's an attractive alternative risk management hedge. And number 5, precious metal stocks will outperform physical gold and silver in an up market. If the markets are up, you'll do better in the stocks. Current valuation is 1886, which means we're undervalued. It's one of the few undervalued assets. We break it up into 4 parts. As a commodity, it's worth about 1720. As a currency, about 1824, approximately where it is at the moment. That's going to be increasing if the Fed doesn't raise more. Inflation number 1900 will drop, so the gold fair value will be the same, but we could probably add $10 to one drop. But in a crisis, we'd easily go to 2100 or higher. If you look at the support numbers, we got down to close to the 1650, one of the places we recommended, and on the upside, it's we can certainly see 2000 this year. Fair value of silver is 26. We're getting closer. 18 and 22 support. 26 and 30 resistance. So obviously it's an asset we like. Oh, I seem to have lost my, I had a chart here, but well, I guess we'll see it later. So when we talk about trading, we're generally shorting markets on strength, and we're buying commodities on weakness. Okay, that's our trading philosophy. And you must take profits daily, usually half. And we re-enter P2 or P3 positions. Technical efforts, that's our second and third resistance lines, our second and third support. If you take the first one, it's blown away. Okay. And remember, there's a lot of material here, which is why we post it on our website. Someone asked if slides are available, but you can just catch it online. Maybe we'll make the slides available, but certainly catch it online. Okay. First quarter, if gold goes down again, which it may, in the 1780 or better, we'll certainly be buying. And silver, if it goes under 22 again, we'll be buying. Copper, will accumulate on weakness because we're in a recession. So on one hand, it will not do as well. On the other hand, it will be stimulated. So we have supply-demand issues. It'll be very tradable. Oil, we like from the long side as we get again into the high season. And U.S. bonds is certainly going back to 380 again to 4. I mean, 380 is our current trade. And we played it 2-3 times. But the trouble with bonds is you need protection because in a falling or recession markets, then people buy bonds. So it's a trading thing, but in general, under 350, it's a buy because inflation's a lot higher than 350. That's general position trading. Now, what we're looking at, and for those of you that follow our Twitter or Telegram accounts, we want to get a sense of the market by following about 12 items. That gives us a flavor where the market really is. I'm going to go into a little detail. One of the bonds. Obviously, the bonds influence the markets. High support around 340, resistance 380, 450. That gives us one flavor. The next, of course, is the S&Ps, and we're playing it at least to 3,400 this time. And if we get over 4,000, it's 4,000 to 4,200. So we look at that. NASDAQ, we've just decided not only we'll break 10,000, but we'll probably go to about 82 to 8,400. Remember what happened before. 4,000, 5,000, 3,000, 2,500, 2,000 and lower. So the PEs on the NASDAQ stocks are still out of sight and can go lots lower and be overpriced. So gold, of course, we're playing to a number of numbers, oil, and of course, if recessions If the bonds are down, oil is going to go up. So there are lots of hedges here. Bitcoin has that 16 support and then 14. Well, those are the big ones before this running. And the only thing that would break that down is either serious regulation, making it illegal, or Tether blowing up. That is to say the truth about Tether. Apple is getting very close to our targets of 125, but it can easily go to 100. We wouldn't be shorting it anymore, but it's got a lot of issues, and certainly 125, 128 was an obvious target for us. Amazon, which has temporary support at 78. Disney is a perfect example, in which we got to our 88 support. Now it's lower because they're totally destroying. It's supposed to be the customer's always right. Well, Disney feels the customers are wrong. Whether you have a philosophy that agrees with the current Disney or not, most of their customers traditionally do not. So they're losing their customer base. Unbelievable. mRNA, which is, quote, doing well, I think is going to be in for some scandals. That's my political views coming out. So I tend to think that's going to be a good short and go lower, certainly below 150, but we'll watch it. Tesla, of course, keeps dropping because you know who is making mistakes, left, right, and center, plus is increasing competition. So that's certainly nothing we expect to see up. The VIX, we watch when it's around 22. RTH is our situation. About 2-3 weeks ago, it was about 170. We think we'll go to 150 because obviously people are not going to shop till they drop. And we like to look at Best Buy because it shows us electronics. It's been holding around 80, but I expect it to be lower. So we look at those every day. We comment on them very often in our Telegram and Twitter accounts, giving the pivots. That is to say, above you want to be long, below you want to be short, unless there's a target to it. Okay, now we have, give me a moment here because we have something here. Was a company we work with, a crew, has probably the best deep data programs that you can find.
Hi, my name is Benoit Brookins, and I'm CEO and founder of Accrue. We are an alternative data analytics company building big data and AI-powered tooling for financial market forecasting. The world is swimming in data, and it is said to be the new gold. We all realize the growing size and value of this data all around us. But let's face it, who really has the time to analyze it? As investors, we just need better risk-adjusted returns more often so that we can do the things we love with the people we want to do them with. Investors are struggling to keep up, and it's explicitly hard to determine the root cause of the market movements we see on short notice. At Accrue, we've been working on solving this problem quietly for almost a decade. We're probably one of the longest-running non-VC-backed startups of its kind. A few years ago, we were selected as one of the most promising fintech companies in the world by the UK government and the London Stock Exchange for our ability to improve life as we know it, living in a tsunami of data. We deliver actionable intelligence for investors and risk managers and help them see new types of blind spots by building an absolutely astronomical calendar, database, and big data analytics toolset technology. We allow investors to anticipate market developments, evaluate pinpointed pre-analyzed ideas, and profit from uncorrelated events like never before. The world is absolutely loaded with unexpected developments. Recently, I experienced my first Florida hurricane myself, and Ian was a doozy. Using our analytics platform, we were able to anticipate the most obvious increase in market risks from a hurricane in a very special way to pinpoint and correlate the market opportunities for systematic value and potential profits based on the on-the-ground activities emerging at pawn shops as people rush for emergency cash and also seek short-term, short-notice pest control services for their homes and businesses as the insects around and animals around seek new places for shelter. Cultural and geographical differences matter in a storm. Take, for instance, when I experienced my first hurricane in Hong Kong, actually a typhoon. The Hong Kong stock market told a different story. Unlike in the USA, where people sometimes rush for booze ahead of a storm, in Asia, people rushed for health drinks and shunned booze ahead of hurricanes, partially because the drinking venues are closed. This is reflected in the market and provided an absolutely incredible opportunity for investors time and time again. We live on one of the most beautiful clocks ever invented. We use the sun to tell us the time of day, the moon to tell us the day of the month, and the stars to tell us the year and which year it is. This year's total lunar eclipse, like many other years previously, was a start of new energy in the United States and all around the world, most notably in the Sun Belt, in the southern US, where people sought new fresh starts in life and in business, as you can see reflected in their appetite for luxury apartments and trophy commercial properties from 1996 to 2022. Our company, we are developing what we call the Internet of Events, which in many ways is a living model of the world, covering a huge array of topics from astronomy to companies to culture. And using machine learning, we interlink these features together and help tell many untold, actionable, fact-based stories. Our database is also featuring a huge assortment of financial assets, economic measures, weather metrics, corporate history, and more for correlation and analysis. We view relation and connection as not just somewhere and sometime, but everywhere and always. There's nothing too local. Our AI systems keep us up to date with macro and local events. Take, for instance, Starbucks. When they open new stores in Brooklyn, as they have for decades, openings of this kind shape communities and influence property values universally. Our data sets allow you to see in chronological order, in context, on demand, when these types of developments happen. We stack up by allowing users to explore more concepts than our competitors with greater ease and allow them to bring their own data, unlike offerings from Bloomberg and Thomson Reuters. We cover foreign exchange, futures, forex, crypto, derivatives, weather, and economic measures that can be correlated with global events. We currently have several offerings, including a self-serve analytics platform and API, in addition to our email newsletter seen here, called Moneyball News Next Week Today, which is soon to emerge on the web as both a web portal and a video blog. We cover 3 global events for the week ahead each week and uncover statistically significant trading ideas for easy consumption and actionable trading. Quantimental research of this quality, typically performed at the most elite financial investment houses, costs enormous amounts of money in just payroll alone, not including infrastructure and data costs. Attendees of the Astrologer Fund conference here are offered a 2-month and 1-year offer up until March 21st, 2023. Email us at team@accrue to take advantage of our special one-time offer, and we hope to hear from you soon. All the best. Bye.
Can you see it, Mark? I won't talk too much about this, but those of you astrologers would know, and we've talked about this 2 years ago, that there are big changes. We talked about this in 2020, that basically between 2000 and 2020, the world is becoming more global, whereas today it's more deglobalization, and you see that more and more happening. And we're just at the beginning of it. But it also represents things like decentralized connectedness, IoT, space explorations, robotics, DeFi, etc. So There are things with crypto, Web 3.0, NFTs, just DAO, etc. We'll talk about that more next year when and after there is some reality, or more reality, should I say, in the crypto space. Again, this is the Jupiter-Saturn in 1 Aquarius. Those of you astrology know this. It's an Adobe, becoming more self-sufficient and interdependent. And again, this is old material, so I'm not going to be talking about it. But let's go forward. Monday in astrology, 2023. 4 big facts. Number 1, the U.S. Pluto return is ongoing. That means big revolutionary, well, more than revolutionary, changes in structures. So that's going on for the next couple of years, and you can see that if you follow politics at all. The second is the April 20th, 2023 eclipse. The third is something we'll talk about, which is from Indian astrology, the Guru Chandra Yoga transit, also in April. And fourth is that Biden has a much more difficult horoscope going ahead than he's had recently. So we are looking for, again, invest for 2024. There are 2 time periods between the 2 solar eclipses, between the April and October. And by the way, it starts a month earlier. And then we've got Pluto entering Aquarius, more focus on the Aquarian elements. Those of you that can read the sun sign book know what that's about. And then next year, as you notice, it will change after the April 2024 and the Jupiter-Uranus. So there are reasons to be more optimistic in 2024 than there are now. Key dates. Last time, of course, one of the things we want to look at is the FOMC. Certainly the first one, is it going to be 25 or 50? Is March 22nd a pause? Not a pause. So those are critical dates. Now, last time, I gave a list of about 20 dates, which were over 80% accurate. This time, the days shifted so many times, 3 times, it's just no point doing it. If you're interested in that type of information, either get on my Twitter feed or my Telegram feed, and that has the information mostly on a daily basis. After next year, we're not going to do it anymore, most likely, but for this next year, when the markets are rock and roll, we feel it's sort of part of our civic duty. So for the dates, just watch the FOMC, because that's the only one of the 4 factors you can really chart out for sure. 1 second. Now, I was asked by the Astrological magazine, which will be coming out in another few days, to write a comment on the Guru Chandala Yoga transit in April 23 in the stock market. So I'm just going to repeat here for you. It's not something I'm familiar with, although I did study briefly with Dr. Raman. I'm not really a Vedic astrologer. But basically it says when Jupiter and the North Node are in the same sidereal sign, which is every couple of years, there is very often near high and low. Many believe this time will be a bearish market for those 8 months. And notice those months are roughly from April to October, give or take a month on either side. What is most interesting is the 2 past occurrences. One in 2001, just before the terrorist attacks, and the other 1929, just before the October stock exchange. I think that gives you an idea of what this could be. So basically, we expect a recession, or at best, very, very weak low growth. Investors should be cautious because of stagflation, again, stagflation if you wish. And we're looking at this 2 solar eclipse between the April 20th and October 20th, and these often have dramatic effects, sometimes very positive, but most often not. And remember, this is a difference from what most people are saying. Most people are saying we're going to go down first quarter and then we're going to start rallying to the end of the year. We're saying we're going to go down first quarter and watch out. Watch your back. Maybe nothing's going to happen, but some big crap could. So the time frame for April has a high probability of a swan event in U.S. politics. Biden will show up in Biden's horoscope and the U.S. Caution is advised. Chinese astrology, it's the year of the water rabbit, and that suggests a jumping trading market. And the rabbit goes forward, goes back and forth and back and forth, and boy, that's going to apply next year for sure. Everybody agrees that. But it's a water rabbit. If anyone asks you why is the market volatile, you tell them because it's a water rabbit year. Fundamental valuations. Copper's reasonably valued at the moment. Gold is undervalued. Silver's undervalued. S&P, you could call it temporarily valued, but it's going to go lower, obviously. NASDAQ, overvalued. Bitcoin, overvalued. Oil, undervalued. Bonds, undervalued. Overvalued. Sorry, bonds go the reverse. So we have our views, and obviously we like to buy when something's undervalued. We like to sell when things are overvalued. We're cosmic value investors and traders. What are our strategies? They're somewhat similar to last year, but somewhat different at the same time. Inflation protection, number one, whether that be in gold and hard assets. Private equity, which obviously is a good place, although very expensive and valuations are coming down. We're trading short bonds till the spring. Blue chip stocks that benefit from inflation with pricing power and profitability for safety from lower numbers, not from today's prices. Once we start to 3,400, we will not be basically short, we'll be long short. I mean, we're always like being long short, but we'll be, and as we get to 3,000, we'll be more short and long. And some real estate, again, those that have long-term contracts, but there will be higher bonds, and that will affect it. So look for something that will do well in a bad environment. These are traditionally 5 assets for the super rich: wine, fine art, farmland, luxury and exotic vehicles, and real estate. I knew 4 of them. I didn't realize everyone was, all these people I'm speaking to own all these great luxury cars and spend hundreds of thousands of dollars. It's a collectible. So those are the 5 classics that people with lots of money do. But when it comes to art and wine, but I actually say wine, especially because you know I'm a wine writer, afund.com/wine, and my last name is Weingarten, which means a wine garden or vineyard. And I prefer the traditional method of wine investing, and that was you buy 2 bottles, and when the price doubles, sell one, drink the other. And that's what they used to do in classic good old England. As for art, you buy art because you love it, not because it might make you rich. Those are my philosophies of art and wine. Other inflation hedges, and here these are from industries, and this comes from Kramer. Fossil fuels, I think they're going to do well. Obviously, there was a problem last year because all these funds were saying, oh, it's evil. Now, of course, they're realizing how short-sighted and stupid it is, because no matter what you want, we can't even have 10, 15% of cars being electric in the next 10 years because we don't have the metals. I mean, the metals and mining industry. You can't have that much lithium. You can't get it that quickly, even if you had unlimited money. There's no way. So deal with what's going on and do what we used to do in the 60s, which is we used to say, let me see if I can remember. It's been a while since the 1960s. Oh, God, what was the saying? I'm going to have to remember this later. Oh, recycle, reuse. Oh, reduce, recycle, and reuse. So to me, it's recycle, reuse, and reduce. That's what we should be doing a lot more. Okay, fossil fuels we agree with. Healthcare, very limited. Not these people with vaccine issues. Travel, I disagree with. Now, we were bullish on travel before. Travel is doing pretty well now, but I think that if we go into the recession, people are going to travel less. So I'd watch that one. It was a trade earlier. It was an obvious trade. Now I don't think it's so good. Defense, unfortunately, is going gangbusters. And food and beverage, you've got to eat, and you don't necessarily have to drink, but we like to drink. So those are areas you want to look at. Number 2, distressed investing, M&A. This is the sweet spot. If you've got access to it and you know what you're doing, just because something's down 80% doesn't mean it's not going down 100%. But if you know what you're buying, then M&A and distressed is honeymoon area. Again, day trading when you want to, and long short position if you want to be safe. And basically, we'd probably be short 3 for 1 long at the moment. And sell markets at least to 3,400. We can go to the 2,500, we can go lower, but if buy with 3,000, we'd probably be pretty neutral, unless there's something really serious happening. Favorite sectors on weakness, the precious metals, battery metals. When things get too high, there's demand destruction. See what happened with lumber, because the cure for high prices is high prices. Entertainment, safety and security. Technology we will like in the summer and fall, much too high. So when we're well below 10,000, and if we get close to 8,000, we'll start looking. And we've talked about this before. The tech and COVID winners of 21, 22 are not necessarily, and probably will not be the winners in 2023. Defensive, dividends, water utilities, inflation protection, ag tech, hydrogen, lithium, and EV plays, I think, when they correct a little bit more. They've been good for us, but they're going through another sector. So I'd wait till they're much lower. And again, 5 to 8% is the inflation floor. Whether it shows up in the numbers, that's really what the minimum is. So I want to give you something that we gave at our last luncheon in New York. We do a bunch of luncheon seminars. So we gave some cheeky safe investors. First of all, as you know, there are excessive deaths from COVID or COVID vaccines, depending on your political views. So Service International, which does funerals, has been doing very well and could continue to do well. Prisons, which have been emptied out, and we expect to see that to change, and that would be the Geo Group is one thing you want to watch. Of course, we have rising labor costs and shortages. You see the railroad people want 25%, the airline people want 20%. Well, hey, you know, at that point, the economics of robotics becomes more compelling, and we can look at something like UiPath. And finally, sex always sells. We had Aspargo Labs, which is going to be doing an IPO in 2023. What they do is, if you take Viagra, as I'm told, instead of taking an hour and a half to 2 hours, it's 15-minute spray. And if you're eating and drinking, it doesn't affect it. So you can be much more spontaneous with the same safety profile. So it seems to me if it's a no-brainer. If you're taking it, I'd rather have 15 minutes than an hour and a half to 2 hours. So that's an IPO you want to look out for. Finally, you've got to be cat-like and simply wait like that cat in front of a mouse hole. We're going to buy silver again if we get the option, and energy on weakness, which could happen if the Fed says they're going to raise rates, and then we'll be buyers. And then finally, this is the most important thing. Be prepared if when a crash comes that you can, and there's truly undervalued quality stocks and assets, be ready to buy, just like it was a couple of years ago when the market was ridiculous. It's nowhere near ridiculous. It's nowhere near valuation. It's still well overvalued. It's going down, but make sure you have cash or opportunity to buy if there is a crash. Very important. Be cat-like. Don't rush into the markets. So our focus, again, and we're going to go into some detail now because since I cut on the number of presentations to 2, and we've made them 5 minutes rather than 20 minutes, we'll have some time for this and questions. I'm going to go into some of them. So we're going to look at less companies this year, number of repeats, blue chips with pricing power. Again, we're in the metals and mining and energy space because that's where we are. Much more allocation to distressed investing. And then finally, and this is not so much for us, but for our international investors, there are going to be some opportunities in Germany, Japan, and UK. Unfortunately, a lot of companies are going to go bankrupt or near bankrupt, but there'll be some public companies that will be undervalued probably in the next 3 to 6 months, and you can focus there if you wish. So those are our key focuses. We're going to summarize, and then we're going to go into some details of some stocks we like. Stock picking will outperform index investing. The 60-40 portfolio is dead. Long live 333, which is bonds, stocks, and private equity. And again, illiquid assets, but again, many are too expensive still. Venture capital, real estate, private equity, and private debt. Markets will not be easy to forecast. Again, long investment horizon. Invest for 2024. And traders, if you hold even a half hour, you may be holding it too long. So we repeat, maximum allocation, which we already have. Stock selection is important. Okay, this is a repeat again. Distressed investing, natural resources. I like to repeat myself. Okay, there's no need for that slide. Okay, we're going to go to mining picks in a moment because there's a lot we have here. We've reduced the number, as you'll see in a moment, not that there aren't many other good companies, and most of these companies are at the right price and time, some of them now, some of them later. These are ones we've been watching for a while. But take a look at this gold seasonality chart. You'll notice that in general, into March, gold, like last year and almost all years, goes up and then goes down. So traditionally, a lot of people exit around past the spring equinox or April. But with certain crises happening, we might not want to exit so much this year. That chart may be moderated. But that's a very classic chart. If you notice, you buy in October, you sell in March. So, big cap stocks, we like Agnew Eagle, DRD Gold, Wheaton Precious Metals. These will give you the least upside, but the most significant downside risk because they're $500 million to several $billion. So if you want really big stuff, those are three of the best run companies that you'd like. Agnew Eagle, DRD Gold, Wheaton Precious Metals. And again, we're going to show a lot of stocks here, but you'll be able to get them on the website, on our YouTube channel. In the mid-size, which tends to give us more risk and more reward, we like Victoria Gold and EMX Royalty. Then in the under 1 million, these are stocks that tend to have much more risk, but much more reward. And we put them in a group of 5. Goldterra, P2 Gold, Soma, Step, and Vista. And these are mostly, although are expiration. And if they hit, they double, they triple, whatever. Although Step is a producer as well, but lots of expiration potential. And there's quite a number on the bottom, and we tend to change them that we're looking at. But I think for the purposes here, 5 is enough in a basket. Now, I have a presentation from our Desert Island play, which is Mag Silver. It's going to be a 5-minute presentation. It's enough to get you hopefully interested. It's in the right sector, membership, silver, because if gold goes up, silver goes up more. Just like if the S&P goes up, NASDAQ goes more. But if gold goes down, silver goes down more, just like now, if the S&P goes down, NASDAQ goes down. So it's a beta on it. Excellent management, we've known for many years, but the reason we like it is it has 2 qualities. One, it's in production, and production is going to increase dramatically next year, but it has expiration upside that's worth buying the stock for that. We see it can be a double very easily. So we're now going to play. Let me get this up. Whoop. Give me 1 second, folks. I know you're so.
Hello, everybody. My name's George Paspalis. I'm the president and CEO of Mag Silver, and thank you for taking your time to listen to us today. Here on the title slide are some very carefully, deliberately chosen words. Emerging. MAG is emerging from a successful exploration and development company into a credible producer. Tier 1, the Valdecañas vein system that we'll be mining in Mexico is a Tier 1 asset. It's one of the highest grade silver mines in the world. And silver is important. Silver has got a great future, particularly coming into the start of 2023. It's a great time to bring a silver mine online, and we are silver. 75% of our revenue comes from silver. And the word producer, we are going to graduate to producer status. It's highly expected that we're going to see our share price re-rate to the same sort of multiples that other silver producers enjoy, particularly with the Tier 1 assets. So now is a great time to get into Mag Silver. We're making some forward-looking statements today. We have a history at Mag of turning forward-looking statements into facts, we like to say. We've had some really great success with our inaugural sustainability report and our Sustainalytics journey with consistent improvement year on year, as you can see. Now, here's a snapshot of the company. We've been producing mineralized material from underground through our partner, Fresnillo, who are a 56% owner and the operator of the Juan Scipio project. We've made $109 million of gross profit to the end of the third quarter, 6.9 million ounces of silver and an astounding head grade of 556 grams per tonne. The average in the Bonanza zone is about 600. You can see our balance sheet's in great shape, $40 million of cash. We have no debt. And it's a great story. Here comes one of the best silver mines in the world online, but only 5% of the property's been explored. We have had success from the very first hole we drilled. And since then, we haven't been able to get away from this corner of the joint venture ground. Lots of analysts, you can research to find us. Here we are, location, location, location. We sit on the Fresnillo trend in Mexico, the preeminent silver district in the world, and you can see the joint venture ground there in blue. Going in on the blue, you can see there's the Valdecañas vein system, driven by the red Bonanza zone, underneath it the blue deep zone, and then other associated veins that we've found. Right-hand side of this shows that 5% pocket. As important as it is that Juan Scipio is coming online as a producer, which is going to be fantastic with all-in sustaining cash costs below $8 an ounce, we're still an exploration story. What we've found here is quite remarkable. The red arrow, it's a source, it's a fluid upwelling zone. This is what every geologist wants to find. And that's why we have such prolific mineralization here. But on that blue joint venture ground you see here, there's probably more. We think there's potentially 2 or 3 more upwelling zones on the joint venture ground. So as a takeaway on Juan Scipio, it's high grade, high margin, district scale. We're generating cash, $109 million for the first 9 months of the year. Our plant is being connected to the national grid, and we will be operating it before the end of the year. So it's a great story, a lot of exploration potential. We have another exploration project up in Utah. It's called Deer Trail. It fits MAG's criteria: grade, size, potential. It sits on the Bingham Trend. This is elephant country. Again, this is location, location, location. And we're coming in here for the first time in probably 100 years, owning all of the ground, one group with one thought process to explore this well-endowed property. We've had one phase 1 drilling. The initial phase 1 drilling has been successful. We wanted to go deep. We wanted to find the right host rocks, and we're now drilling phase 2, and we hope to find some of these red manto chimney type structures, which are quite significant in terms of their grade. The average grade here is 465 grams per tonne. The size could be quite substantial, and we're in phase 2 now, and we'll be releasing those results in early 2023. And then we have one more asset. It's an exploration property in Ontario. It sits on the prolific Cadillac Larder Break. Again, I'm going location, location, location. This is a 7-kilometre stretch on the Cadillac Break. Who's who of major gold mining companies sit around us here. And our opportunity here is to come in and take a different approach, drill deeper. It's known in this area, the Abitibi, you have to drill deep to find the good grade. There's a lot of low-grade resource mineralization near surface. We're not interested in that. We picked this up for $16 million. It's a great opportunity. We're in phase 1 drilling now, and watch this space. We're excited about the results there. So catalyst for us, we'll continue to process through Fresnillo, the operator's adjacent plants, till we start our plant up here just before year end, which is making cash flow. We're going to get into our plant commissioning in the next day or two with the electricity off the grid. Getting into 2023, we'll see full production and cash flow, and Deer Trail, Larder Lake, Again, early stage exploration. We're excited about those properties. We're excited with what we've seen on the drill bit so far. So watch that space. Thank you everyone for your time. And if you need more information, there's the website, www.magsilver.com. And we're always available to take phone calls. Bye, everybody. Have a great 2023.
Bye, everybody. Have a great 2023. Do you see it, Mark? Oh, shoot. Oh, shoot. Excuse me. Okay, folks, we'll be back in a second. Okay. We have about another 15 minutes, and then we're going to take questions and answers. If you have questions, feel free to put them in our chat room. We'll try to get to them. Okay, from current slide. Again, silver is, generally speaking, both an economic metal and a monetary metal, so it has a slightly different parameters than gold itself. Our two favorites at the moment, Mag Silver, which you've already mentioned. We have fairly high targets for that. We think a double. And Heckler, which is another very, very good company. And there are a number of copper and base metal companies. If you notice, we put in a group of 5 because, generally speaking, it's very difficult to just have one pick. If I only had one pick this year, it would be Mag Silver, but it's very dangerous to have one pick. For example, about 25, 30 years ago, when I was first starting out, I was in a trading contest with 2 other people downtown. There was me, a neo-financial astrologer. There was a Playboy bunny using a dartboard. I tend to think that may have been the reason most people were there. And then we had a monkey, which apparently chose. Now, I would like to point out that in the pick I had, I beat the Playboy bunny, but the monkey beat me and had a better result, which just goes to show you don't always want to have one item. Traditionally, as a fund manager, we get between 20 to 25 positions, which is the maximum way to hedge your bets. But in groups of 5, especially with higher risk companies, we tend to like, if you're dealing with the micro caps or the small caps, put them in groups of 5, balance them out, and a couple of good winners and occasionally some losers. But anyway, the 5 we like there are Adventus, Calinex, Kodiak, Trilogy, and O3 Mining, which are in the base metal area. There are others we're looking at, but those are things we can tend to think will do better. Again, when we buy them, depends on what you think the markets are going to do. And the battery metals, we're a little bit on lithium. We think it's a bit overdone at the moment, as well as the EV. Some of it's on hold. We do like E3 metals at the moment because it's still very undervalued. And then we have the clean air metals and the rare earths, which are coming back because they're getting a lot of money from the government thanks to the Inflation Act. And we've got electric battery metals, Nova Gold, and Nova, that's a good one too, but Nouveau Monde, clean air metals, and the metals company, which we referred to before. So that's another batch you could take a look at. Again, better than just one pick in general. Healthcare is good, so we have some aggressive ones, again, in a batch. Arch Therapeutics, Avivagen, Confit, and Heart Test Laboratories, again, of various levels. These are high-risk ones, which means there could be some problems, but tremendous possibilities. So we have a long list we look at. Energy and distress. Obviously, if you get something like Exxon or Chevron or Shell, etc., these are going to do well because they're inflation protected. But then there are other things like Riley Exploration, which has a good beta, or Energy Management, Schneider Electric. So I tend to personally like the higher risk ones. But certainly the energy is good, clean energy also, but most of that is not profitable yet, just with government support. Defensive, this is something you want to look at. I tried to come up with 5. You could just buy the Noble Aristocrats, but that barely made money this year. It wasn't down, but it wasn't really up. So we chose 5 that we like. Acme United, which is one of the best run American companies, Global Self-Storage, Penske Automotive, and then 2 industrials that do industrial REITs, either Stag or Carry and Verizon. Put it together. I think that's fairly safe. Again, this is something I'll be more likely to buy when we're at 3,400 or lower, but you could track them if you wish. And there are other classics in there like Johnson & Johnson, and as one of the major investors used to say, they'll always do well because people always have boo-boos, etc. Microsoft, you know the usual things. But you want to allocate something to defensive, especially as markets go much lower. No rush at the moment. Media and entertainment, we're putting a batch together. It's a little early. Live Nation, Samsung, Sony, and Glimpse. Agriculture. Now, security and defense. As I mentioned last year, they were going to do very, very well. I wasn't happy about it. I didn't play it. But Northrop Grumman, as of Friday, was up 36%, Raytheon up 14%, and Lockheed Martin up 35%. I believe that there's going to be less money next year, so while they'll do well, they'll do not as well as here. So I would be starting to reduce or lock it in. I don't think the Ukraine war is going to be that much longer. In any case, that is something that made money. It will probably not lose money, but I don't think you're going to get the outside returns that we forecast last year, but did not play. Distressed investing, best area possible. Look at least to things outside the 52-week or March 2019 valuations, ideally lower. We'll deal with this more later, but I haven't seen much distress yet. It's coming soon to a trading screen near you. So the final thoughts are, invest for 2024. There'll be great physical and economic challenges in 2023. Invest for 24. Have the ability to buy if when markets panic. There'll be winners and losers. Good stock picking will greatly outperform index funds. Invest for 2024. And in a moment, I'm going to take your questions. Personally, our goal is to make more money with less risk. Trading, we do astrology and technicals. Our motto is be there first, sometimes early, which is why, because we're playing options. Investing, astrology and fundamentals, always a stellar performance. We have a number of investments for market professionals in New York. We present some of these companies, and we'll have our annual update August 16th. We will update our stock and commodity forecasts. So now what we want to do is take your questions, basically put them in the chat room. Let me look at them in order, if I can find it here, and we'll go from there. Okay. Is it possible to get the slides? At the moment, we're not making the slides available, but we will be posting this in 2-3 days, so you could stop it and get it. Too many people edit the things and change it on us, so. Okay, whoop, why can't I get this down? Why do I think Disney will go lower? Okay, the reason we think Disney's gone lower for several reasons. First of all, we're going into recession. I don't know if you've been to Disney in Orlando recently. The prices are through the roof. Through the roof. So that's not going to be good. Number two, they have a very woke philosophy, and generally speaking, the people who like Disney, with exceptions, the majority of them are very traditional American values, which this is not. And if you follow any of the chart boards, you see these people say, I will never deal with Disney again. So they're losing their customer base. They're telling their customer base, we don't care about you, follow us. Now, you may agree with their philosophy, personally or not, but as a business philosophy, it's losing. So because of the recession, and because of the fact of imposing a woke philosophy on an unwilling group, they'll continue lower. And if we look at the, just one second, let me just take a look at the current, I think their PE is still out of line. Let me just see, spend a moment. And Disney's PE, last time I looked, is still 50 to 1. It should be 20, so it can easily drop in half. Right now, you've got things with 50 PE. Is Disney growing? Yeah, they do have the internet side, but they're losing a lot of customer base. And until they change, which they probably won't, or they may not, it's going to stay down. So basically, Disney's down. Telecom stocks, I don't follow as much. I just chose one because you still have to use your phones. But it's highly competitive, and I'm not in a rush, but it does have a nice dividend. So if we take a look at, again, just very briefly, and I happen to be Verizon customer, so naturally I think about it. That doesn't mean the others won't do well, but it's not my area. We're trying to give something that could be appropriate. But let's take a look at Verizon, and it's got a PE of 8. It's under the average of 15. That's a very low PE. So, hey, where's that going? So I tend to think it's an undervalued stock. So, again, I'm not rushing to buy anything, but I think at 8 PE I much prefer to one that's 50. Okay, I'm going to also put up the questions and answers if anyone wants to be verbal about it in a second. Audio for Cruise Bad, I apologize for that. Basically, it was given at the last minute. It's a company, it's very interesting. Just go to their website. All right. Okay, can't hear. Mag value and audio. Okay, well, same issue. I'm sorry about that. That came out good here. I'll try to correct that next time. I wanted to have it where we would have this recorded and people would have it. It's a great company. Go to their website and take a look at what they have. Ah, that's interesting. You didn't hear it here, so I don't know why that was the case. The key dates. Ukraine, I don't want to give. This was like during the Vietnam War when I was asked by the government to give dates. I don't want to do that. You know, I lived with the first U.S. Mideast war that we predicted 4 years out to within 4 hours, and I had to live with that for months to see if I'm right. I don't want to give the dates. Let's just say that when everyone thinks things are wonderful and we get to within a month of the eclipse of April and the Guru Chandra thing, it can happen. And anywhere over those 6 months, it's enough to know. We don't need to know. We're just going to protect ourselves. I'm sorry. I don't want to live with it anymore. Okay. Why is this not coming down? Oh. War between India and China. Again, I don't want to predict that. I did that when I was younger. I'm not interested in doing that anymore. Let's hope it's not. Could happen, but I'm hoping not. I think there are more questions here. Where are they? Insurance companies. I've thought about that, but I haven't thought about much. Basically, if I were a life insurance company, I assume you're losing money, but I don't know because you also raise rates. It's not something I cover because bank stocks, which obviously were good beforehand, as long as interest rates go up and people don't go and it's a soft landing, then the banks are in good shape. If it's a hard landing and they start writing it off, it won't be so good. Insurance, I'm a little concerned about. On the other hand, they often make money when there are a lot of disasters. So it's not my area of expertise. China, how much percent it will matter in the future? Quite a bit. I'm not going to China this year. I was in Hong Kong 5 times in the last 3 years. I'm afraid to go because I can go there. They can decide to lock me up, and I'm stuck there for the next 6 months. So it's got to affect them. Exactly the level, I don't know, but the level of trust has gone down and needs to be put back. Okay. Is that it on my questions? Let me just see. All right. I think I have a question and answer period here. So we'll give it another 2 minutes if there are any questions. Basically, we've given you a lot of material. I think it's mostly true. And you can make money if you follow it. I believe so. And I think that seems to be the questions. I hope you found this valuable. And again, I'll be posting it up on our website. And if you're a trader, at least for a short period of time while markets are crazy, take a look at our Twitter feed, at TAA Fund, or our Telegram feed, capital TA Fund. Thank you very much, everyone, for attending, and I wish everybody the best.